Hello guys, welcome to CADS 3853 module number 3. In this module, we will delve into the profit and loss statement, extending our discussion from last two modules. We will learn specifically what specific elements of operation go in the calculation of the three drivers of profit, which include net sales, cost of goods sold, and operating expenses. The profit and loss statement sometimes is called an income statement or operating statement by different people in the industry. The P&L statement or profit and loss statement summarizes business activities for a particular period. Usually the period could be like a quarter, so like 4 times a year, or it could be an annual profit and loss statement that summarizes activities for the entire fiscal year. The P&L statement captures the interplay of sales and cost of goods sold and operating expenses, all of which determine the profit or loss that the company achieves. Now let's revisit the famous profit equation that we've been looking at a lot. So net sales minus cost of goods sold is gross margin. Gross margin minus operating expenses will lead to our operating profit or loss. If you look at this equation carefully, then you will notice that what's actually driving profit and what we can actually do through our operation to maximize our profit will be to work on the net sales, cost of goods sold, or operating expenses, those three things. Although gross margin shows on in this equation, gross margin, the way we calculate gross margin is net sales minus cost of goods sold, which means gross margin itself is driven by net sales and cost of goods sold. In other words, to have an impact on the gross margin, we have to increase or decrease net sales, or the same way increase or decrease cost of goods sold, and that's going to lead to an increase or decrease in gross margin. The direct factors that influence profit will be net sales, cost of goods sold, and operating expenses, those three things. And gross margin is more of a the higher the gross margin, the higher the profit. However, gross margin itself is driven by net sales and cost of goods sold, so we have to actually work toward increasing net sales and reducing cost of goods sold for us to be able to increase gross margin, which will have a trickle-down impact on our profit. So in this module, we are going to take a look at the detailed elements that go in the calculation of these three drivers of profit, which include net sales, cost of goods sold, and operating expenses. Let's take a look at net sales first. By definition, net sales means all the sales total for a given period after deducting any customer returns or allowances that we have to take off from gross sales. Now let's take a look at what gross sales and then customer returns and allowances actually mean, and that will give us a better idea about what net sales are. First, let's take a look at gross sales. Gross sales basically mean all sales dollar for a period that you obtain from all records of sales. So all the initial dollars that you receive from all the sales, all the merchandise that you sell during a given period. From the gross sales, sometimes you have to take some dollars off because maybe customer returned the merchandise and you had to fully refund the sales back to the customer. Or sometimes the customer may submit some rebate forms that you have to refund some part of the partial dollars from the sales back to the customer, or any other adjustment that you had to make once the sales have been made. So the gross sales have been already made, but you have to adjust these dollars so that you basically get it back to the customers. And you add up all those dollars that will be constituting the customer returns and allowances. When we express customer returns and allowances in a percentage numbers, or like a 2% customer returns and allowances, that percent is actually percent of gross sales. So how many percent of gross sales, all sales dollar that we received, they had to be actually returned back to the customers as customers and returns and allowances. That's the concept of customer returns and allowances percent. So that makes the formula to calculate net sales pretty simple. You just have to subtract all the customer returns and allowances from gross sales, and that will be your net sales. Let's work on an example problem to calculate the sales. Let's say in this case the gross sales for this store were $1,500,000. During the same time period, customer returns and allowances total $25,000. Okay, in this case, what would be the net sales for this store? And given the information, what is the percentage of what percentage of gross sales were actually returned or allowed back to the customer? So that basically calculating customer returns and allowances percentage. Let's pause the video here for a second and work on the problem. Okay, let's see if you got the answer right. Okay, so the first question was asking for a net sales dollar. So net sales is gross sales minus customer returns. It's simple. $1,500,000 minus $25,000 that were given in the problem. So that leads to a net sales of $1,475,000. The second question was asking customer return and allowance percentage. So this percentage is a percent of gross sales. So you're going to have to divide your customer returns and allowances dollar by gross sales dollar. 25,000 divided by $1,500,000. That will be 1.67%. Be careful in showing your percentage numbers, and I said for the rounding policy of this class, you have to always show 2 decimal places for all dollars and all percentage numbers for your problems. So for you to be able to show 2 decimal places, 2 places after the decimal point for a percentage, when you initially calculate the decimals, you have to know at least the 4 places after the decimal point, in this case 0.0167, the 4 digits, so that you can you are able to show the 2 places after the decimal point for the percentage answer. So that was a very simple problem. Let's work on another problem. Again, it's pretty simple. Okay, the same store, the same gross sales, $1,500,000. But let's say in this case, the customer returns and allowances totaled 2% of gross sales. Okay, if that's the case, then what will be the net sales? Again, let's pause the video here and work on the problem. Okay, then let's take a look at the answer here. The problem gave gross sales dollar and the fact that customer returns and allowances were 2% of gross sales. From these 2 pieces of information, we can easily calculate customer returns in dollars. It's 2% of gross sales, so that means 2% times gross sales dollar, $1,500,000, which leads to $30,000 customer returns and allowances. Then net sales can be calculated from the gross sales dollar and customer returns dollar. So gross sales dollar minus customer returns dollar is net sales dollar, which is now $1,470,000. It was pretty simple. So net sales calculation was not all that complex. On the other hand, cost of goods sold, let's take a look at cost of goods sold now. Cost of goods sold is basically the total cost of obtaining the merchandise and preparing the merchandise for sale. Okay, so there are a lot of elements that go in the calculation of cost of goods sold. We have to think about a lot of different factors. And the cost of goods sold elements sometimes may be given as dollar numbers, or maybe sometimes given as percentage numbers. When the cost of goods sold elements are given in percentage numbers, we have to be very careful in understanding, okay, this is percentage of what? Percent of what? The rule of thumb here is if a cost of goods sold element is expressed as a percentage, then it is all percentage of purchases, with one exception. The exception is the alteration cost. When alterations are given in percentage numbers, that's a percent of net sales. Okay, so except for alteration, which may be percent of net sales, all the other elements, if they are given as percentage numbers, that's percent of purchases. We'll see what that means once we take a look at each of these elements and how to actually put them together to calculate cost of goods sold. So there are a lot of different elements that drive cost of goods sold. In the cost of goods sold calculation, the adverse element that we have to think about is how much stock that you actually started the period with, which is what we call opening inventory or beginning inventory at their cost value. But on top of what you already had at the opening or beginning of the period, you sometimes also add in new merchandise on top of that opening inventory. And those new merchandise is what we call purchases. How much more purchases have you made since the beginning of the period? And when you do make purchases, sometimes we also have to pay the transportation to ship the merchandise that new purchases into the store. So all of those transportation, or we sometimes call it freight. Freight and transportation mean the same thing. All the shipping costs that the buyer, the retailer had to pay for the merchandise that were bought will have to be figured in the calculation of cost of goods sold, because it's part of the cost that is spent to obtain the merchandise. All these three things, the opening inventory, purchases, and transportations, are factors that increase cost of goods sold. So the more the opening inventory, or the more purchases you make, the higher the transportation, the higher the cost of goods sold is going to be. But then, because the cost of goods sold is cost of goods sold, you only care about the cost that was involved in the merchandise that was sold, right? For that matter, if there was anything that was left unsold at the end of the period, the cost involved in that kind of merchandise has to be taken off. And that's what we call closing inventory, the amount of stock that were left in the store at the end of the period. Okay? So the closing inventory, again at the cost value, or ending inventory, has to be subtracted from the previous calculation, the opening inventory plus purchases and transportation. From there, you have to subtract closing inventory to be able to have a more accurate calculation of the cost of goods sold. And this is not it. There are more elements that we also have to consider, and we'll take a look at them on the next slide. Cash discounts are the discounts that the buyer receives from the vendor when the buyer pays the invoice early. So when you do receive this kind of discounts, it is going to be a reduction in the cost. So the cash discount amount has to be subtracted from your cost of goods sold calculation. Sometimes then you may have a lot of merchandise left in the store, and you negotiate with your vendor so that the vendor will actually take it back. Those kind of cases are called returns to vendors. So the merchandise that is returned to the manufacturer or the vendor for full or partial credit when they are kind of left in the store unsold at the end of this period. If that kind of arrangement can be made, and this is again going to be part of your not going to be part of your cost of goods sold, so you have to subtract that much amount. Finally, you may have sometimes a case where you had to alter the merchandise to be able to sell them. And if you happen to pay for those merchandise, the retailer, you happen to pay for those merchandise alteration instead of the customer paying for the alteration and workroom cost, in that case, that is part of the cost that has to be figured in the cost of goods sold, because it's the cost of preparing the merchandise for selling it. So the workrooms or alteration costs will have to be added in to the cost of goods sold. So given all the elements of cost of goods sold we've just taken a look at, let's see how they are actually put together in the calculation of cost of goods sold. So we started with the opening inventory at the cost value, and you add in the purchases at cost, and add in any transportation or freight that we had to pay, and that combination of these three elements are called total merchandise handled. And then from total merchandise handled, we subtract closing inventory out, because we didn't sell this merchandise. It has to be out of the cost of goods sold. It should not be included in the cost of goods sold, so we subtract that, and that leaves us gross cost of merchandise sold. And then if we are able to return any merchandise to vendors, that also has to be subtracted. If we received any cash discount from the vendors, that will also have to be subtracted, which leads to the net cost of merchandise sold. And finally, if we paid any alteration or workroom cost to prepare the merchandise for sale, then that cost has to be added in, and that leads to our final cost of goods sold. And you can see that there are three intermediate terms of cost of goods, cost of merchandise, called like total merchandise handled, gross cost or net cost, and things like that. And I am okay if you don't remember these terms at this moment. But what's important is what are the other all the cost of goods sold elements, and whether those each of these elements increases or decreases cost of goods sold. So on the next slide, we're going to see the shortcut calculation after ignoring these intermediate terms, the TMH, gross cost, and net cost, and just take a look at the actual elements of cost of goods sold and see how they are put together in a shortcut calculation formula. So here's the shortcut calculation for cost of goods sold. So opening inventory plus purchases and plus any transportation, and minus closing inventory, minus returns to vendors, and minus cash discount, and finally add in the workroom or alteration costs that you had to pay, okay? And that lead to our cost of goods sold, okay? So even if you don't remember the three intermediate kind of cost term, like total merchandise handled, gross cost, net cost from the previous slide, that's perfectly fine, but you will have to remember this shortcut calculation formula for cost of goods sold. And this indicates all the elements that we need to consider in the calculation of cost of goods sold and their roles, whether they are adding in or they have to be subtracted in the formula. So let's practice the cost of goods sold calculation with a practice problem here. Using this information, let's calculate cost of goods sold. And there's a lot of different pieces of information that are given here, and let's take a look at each of them and see if the information is relevant to the calculation of cost of goods sold, or if there may be some of the information that is not relevant to these questions. So purchases. Purchases is one of the cost of goods sold elements, right? We just took a look at. So yes, we need to use this dollar, purchases dollar. Freight is the same as transportation, and we know that it has to be figured in the calculation of the cost of goods sold. Gross sales. Is gross sales an element of cost of goods sold calculation? No, right? Gross sales are used to calculate net sales, because net sales is gross sales minus customer returns and allowances, but that's gross sales are not part of cost of goods sold calculation. Alterations, yes, that's part of the cost of goods sold calculation. Opening inventory, closing inventory, they are all elements of cost of goods sold. Customer returns, again, customer returns not part of cost of goods sold calculation because customer returns are used for net sales calculation. Return to vendor, RTV is returns to vendor. That's important element of cost of goods sold. We have to use it. And it says returns to vendor is 4%. Then 4% of what? In the beginning of the cost of goods sold discussion, I mentioned that when cost of goods sold elements are given in percentages, you have to be careful in understanding what this percentage is of, right? Returns to vendor will be percent of purchases, right? So this 4% means 4% of purchases. So purchases was $1,200,000. So 4% of that would be the returns to vendor. You know how much was returned back to the vendor. Next, cash discount is given as a percentage again, 2%. Again, this would be 2% of purchases. Okay, so to calculate cash discount in dollar, you're going to have to multiply 2% by the purchases dollar. Okay. Like I said earlier, that all the elements of cost of goods sold, if they were given in percentage, that will be percent of purchases, with one exception. That exception is alterations. Okay, in this problem, alterations were given in dollar figures, so we don't have to worry about the percentages. But if it were to be given in percent, that would be percent of net sales, not percent of purchases. Okay, so that's the only exception. So I suggest that you first turn all these percentage numbers, returns to vendor and cash discount, those percentages into dollars first, so that we can put those dollars back in the cost of goods sold shortcut calculation formula we just saw in the previous slide, to be able to come up with the right answer. Okay, let's work on this. To pause the video first, right? So let's check out the answer. First, I said, well, let's turn the percentage figures into dollars first. So we had two percentage figures, return to vendor and cash discount. Both are percent of purchases, and returns to vendor being 4% of purchases. So to convert that into dollars, you had to multiply 4% by the purchases dollar, which was $1,200,000. That makes the returns to vendor of $48,000. The same calculation type of calculation goes into the cash discount dollar calculation, which is now 2% of purchases, so it's a half of the returns to vendor. So now we have $24,000 cash discount. And then once you have those two numbers, we just figure all the dollar numbers into the shortcut calculation formula for cost of goods sold. So that is opening inventory plus purchases plus freight or transportation minus closing inventory minus return to vendor minus cash discount plus alterations. If you do this calculation, you're going to have the answer of cost of goods sold of $1,275,000. I hope you got it right. Now let's continue with this cost of goods sold problem number 1, to calculate gross margin in dollars and percentage. We just calculated cost of goods sold from the given information, and the cost of goods sold came out as $1,275,000. To calculate gross margin, we need to know not only cost of goods sold but also net sales. So from the information that was given earlier, which is shown here now, we need to calculate net sales from, we know that the net sales is gross sales minus customer return, and we have that information here, gross sales of $2,460,000 and customer returns of 6%. And again, when it's a percentage, we always have to think about what is this percent of, right? Customer returns is percent of gross sales. So this means 6% of the gross sales of $2,460,000 will be actually customer returns dollars. So I guess to calculate the gross margin in dollars, you're going to have to first convert this customer returns 6% into dollars first, and then subtract that customer returns dollar from gross sales to have the net sales. Then once you have net sales, then net sales minus cost of goods sold will be your gross margin dollar, right? So you can calculate it that way. And gross margin percent can be calculated by dividing the gross margin dollar by your net sales dollar. Okay, so let's pause the video here and work on this problem, and then we'll check out the answer on the next slide. So let's see. So net sales is gross sales minus customer return, and customer return was 6% of the gross sales. So that is 6% times $2,460,000, which is in the parentheses. And you subtract that amount, which was $147,600 from your gross sales, $2,460,000. That leaves you with a net sales of $2,312,400. We already knew the cost of goods sold was $1,275,000 from the previous calculation. And then gross margin dollar will be net sales minus cost of goods sold, which is $1,037,400. To calculate gross margin percent, finally, you divide the gross margin dollar by net sales dollar, which we calculate first in this slide. And that leaves us with a 44.86% gross margin. Okay, since the cost of goods sold calculation is a little bit complex with a lot of elements to think about, let's practice it one more time with this second problem. let's see what information is given to us. So purchases, again, we need the purchases to calculate cost of goods sold. Transportation, again, we need that. Net sales, do we need net sales to calculate cost of goods sold? No, we don't. Alterations, alterations are given in percentage number. Now 1% of what would be the alterations? Okay. Well, I said earlier, alteration is the only exception, right? So alteration is 1% of net sales. Well, here we go. We can use that net sales figure we just saw, $3,200,000, to calculate our alteration in dollars. 1% of that $3,200,000 will be alterations, right? And opening inventory, closing inventory, returns to vendor, cash discount, all information or elements of cost of goods sold that we need to think about. Cash discounts are given in percentage number, so 2% of, then what? 2% of purchases, right? So it will be 2% times the purchases dollar will be cash discount in dollars. So again, first convert all these percentage figures into dollars first, and then utilize all these dollar figures in the apply them into the shortcut calculation formula for cost of goods sold, so that you can easily calculate cost of goods sold. Let's pause the video here. Okay, now let's take a look at the answer. Okay, so first let's see the percentage numbers. Cash discount and alterations were given in percent. So cash discount is 2% of purchases. So 2% times purchases, $2,200,000. So that comes up to $44,000. Alteration was percent of net sales, and 1% of net sales. Net sales were given in the problem as $3,200,000. You time that by 1%, that is $32,000. That's what we have. And then plug all the dollar figures into the shortcut calculation formula for cost of goods sold. So that is opening inventory plus purchases plus transportation minus returns vendor minus cash discount minus closing inventory plus alteration, and that leaves us with the cost of goods sold of $1,313,000. Good. I hope the cost of goods sold part was not so challenging to you. Operating expenses is the next thing that we also have to delve into, and operating expenses are a little bit simpler than cost of goods sold. Kind of compare cost of goods sold and operating expenses in terms of the definition. Cost of goods sold was all the expenses or costs that were involved in obtaining and preparing the merchandise for sale. Now, operating expenses is the opposite. All the expenses or costs that are involved in non-merchandise the business operation. So it is defined as the non-merchandise cost of running the business. So any other expenses and costs besides the cost of goods sold will be considered as operating expenses. A lot of times we break down operating expenses into two categories: direct expenses and indirect expenses. Alright, direct expenses are the operating expenses that are spent directly by the specific department or store that you are calculating this P&L statement for. So like if you are a multiple department kind of store, like you have department store like JCPenney or Nordstrom, they have multiple departments: women's wear department, children's wear department, men's wear departments. In that case, any expenses that are spent specifically for that department will be considered as direct expenses. Okay, so for women's wear department, what women's wear department spend would be the direct expenses of the women's wear department. So these direct expenses would cease if the department ceases to exist. So if you get rid of the department, this direct expenses will disappear. Okay. So for example, like women's wear department, in that case, like the women's wear buyer salaries will be direct expenses of the women's wear department. any salespeople salary, for the people who are working in the women's department, that will be direct expenses for women's department, wear department. The buyer's travel expenses will be the women's wear department's direct expenses if the buyers are women's wear buyers. Any kind of customer delivery that you had to provide for women's wear customers will be direct expenses for the women's wear department, etc. If you are owning a one little boutique or one store only, then every operating expense dollar will be direct expenses, because if you close the store, then no expenses will occur anymore. So that basically is the concept. But if you are owning multiple stores, then direct expenses for each store will be calculated for what's spent directly by the store, but there may be some overhead costs that multiple stores are sharing, and those will be indirect expenses. The same goes for like department store where there are multiple departments. There are specific expenses that are directly spent by the department only, but on the other hand, there may be some other expenses that are shared across department, and those are what we call indirect expenses, which I will explain again in the next slide. So indirect expenses, as I just mentioned, are the expenses that are not directly related to the specific department, but that are shared across multiple departments. Okay, so that could include the maintenance costs for the facilities that is shared by multiple departments, rent of the space that is shared by multiple departments, depreciation of any kind of physical properties that is shared by multiple departments, insurance to ensure the safety of the entire the space that is shared by the across different departments. Those kind of things would be examples of the indirect expenses. When those indirect expenses incur, the different departments will have to share a portion of it, right? So the portion that is assigned to your department will be now becoming part of your department's operating expenses. So the calculation of operating expenses is pretty simple. You just have to add up all the expenses, whether they are direct expenses or indirect expenses. Sometimes we may want to kind of separate them out, by direct and indirect expenses, and to see how much we're spending for direct expenses and indirect expenses, just for the purpose of analyzing our expenses. And in case there's anything that we need to do to reduce the expenses, then we know that whether it's direct expenses or indirect expenses. Direct expenses are things that you have more control over because it is directly spent by your own department or your own store, whereas indirect expenses may be a little bit hard to control when it is by each individual department or store, because it is shared across multiple departments or stores. So you're going to have to make the decision at the kind of upper administration level rather than on a department level or store level. So whatever expense it is, whether it's direct or indirect, all expenses will have to be added up to know the total operating expenses. So knowing the concept of operating expenses, let's do one problem here. Not only calculating operating expenses, but let's try to draw a complete P&L skeleton that includes all 5 components: net sales, cost of goods sold, gross margin, operating expenses, and profit or loss in both dollar and percentage, with the given information here. Okay, so let's kind of see which pieces of information need to go to calculate net sales versus cost of goods sold or operating expenses. Here gross sales are given. Gross sales is an element of net sales calculation, right? Customer return is again an element of net sales calculation. We know net sales is gross sales minus customer returns. Cost of goods sold, luckily this time we didn't have to do the complex calculation because cost of goods sold is given as a one single number. And now we see salaries, advertising expenses, utilities, miscellaneous expenses, and rent. They are all examples of operating expenses. So you're going to have to add up all these 5 expense categories that are given here to calculate total operating expenses. Then once you know operating expenses and net sales, given this information, you can easily complete a P&L skeleton. Okay, let's pause the video here and work on this problem. Alright, let's check out the answer. So net sales, you have to take gross sales and then subtract customer returns. So that gives us $2,980,000. And for operating expenses, we had to add up all the expenses that were listed, including salaries, advertising expenses, utilities, miscellaneous expenses, and rent. And that was $284,000. Cost of goods sold was given $1,700,000, and gross margins calculated by subtracting cost of goods sold from net sales, dollar, and profit, dollar, is calculated based on gross margin minus operating expenses. And in terms of the percentage numbers, all on net sales is always 100%, and the rest of the percentages can be calculated by dividing the corresponding dollar of that component by the net sales dollar. So, like for example, cost of goods sold percent will be cost of goods sold dollar divided by net sales dollar, and everything else will be the same way. I hope you got everything correct. So we have taken a look at the three key components that drive the profit: net sales, cost of goods sold, and operating expenses in more detail, and what specific elements actually go into the calculation of each of these three components. For example, net sales would use gross sales and customer returns. Gross sales minus customer returns or allowances would be total net sales. Cost of goods sold uses a lot of different elements to think about. So starting from the beginning inventory, you add in new purchases and any transportation that you had to pay along with the purchases, and then subtract closing inventory that didn't get sold, and subtract returns to vendors, and subtract cash discount that you received from the vendor, it's deduction in your invoice, and then add back in any alteration or workroom costs that you had to spend, and that will be your total cost of goods sold. Operating expenses were pretty simple. You just had to add up all the expenses, all the non-merchandise related expenses. Sometimes these expenses may be broken down into indirect versus direct expenses, and you just have to add up all the indirect expenses and direct expenses to come up with your total operating expenses. So knowing this, we can now think about what to do to improve profit. So what to do with the net sales, what to do with the cost of goods sold, and what to do with the operating expenses. And we'll talk about it in the next slides. The utmost goal of any business is to maximize the profit. And we just took a look at the P&L statement, which gave us an idea that for us to maximize profit, we need to work on three things. Net sales, cost of goods sold, and operating expenses, those three drivers of profits. Then what should we do about net sales? Of course, we would like to maximize net sales as much as possible because net sales is a positive factor on profit. For us to increase net sales, and we know that there are two elements of net sales: gross sales and customer returns and allowances. And we will have to increase gross sales and try to reduce our customer returns and allowances. That way we can increase net sales. Okay, then what should we do to increase our gross sales? A lot of things can be thought about, but strategically, increasing gross sales could be done by selling a lot of items in the unit-wise, quantity-wise, but also it could be the even if you sell the same number of units, if you can charge a higher price for each unit, then that's going to also increase your sales. How are we going to be able to do that? Is a couple of ways that you can think about. One is to improve your brand image so that it would allow you to command a higher price premium, and still consumers will be willing to buy your products. In that case, because of the higher priced premium that you can charge on each item, your sales are going to increase. Another thing that is important in terms of merchandising is the accurate merchandise planning, assortment planning, and the timing planning, the delivery planning and things like that, so that you are going to get the right merchandise for your target customers at the in the right timing and in the right place, in case you have multiple stores and which location you want to send this merchandise and that merchandise, those kind of merchandise mix planning. When you have the right kind of planning there, that way you can sell more items at their regular price with less markdowns, which is going to increase your sales dollars. Then we also have to think about what do we do with the customer returns and allowances to increase our net sales. Obviously, the more the customer returns and allowances, the lower our net sales is going to be. So we are trying to decrease, minimize the returns from the customers and any other allowances that we must take. Then how can we reduce returns? If you think about it, when would you return merchandise as a customer? That's probably when you just when you purchase something and you go home and you try it on, you just found that you didn't like it, or there was some problem with the merchandise. So you kind of have to get rid of these kind of factors. So improving merchandise quality so that it wouldn't when the customer goes back home and try it on, and they won't regret purchasing it. Reducing merchandise defect is another thing. You don't want a lot of items to be returned to you because of defects. Improving garment fit is important because sometimes you may have actually nice magic mirror that makes you look really good in the fitting room. So you just purchase the merchandise and go home and try it, and regular mirror in your house doesn't make you look as good, so you may have to return it, things like that. And if you actually have a better garment fit and the merchandise fit to your customer's body, that may reduce that kind of chance a little bit. Taking good care of merchandise is also important. This basically means within the store, take good care of the merchandise so that the merchandise is not going to get shop worn, and so that it would not look like it is new merchandise, and things like that. If that happens, then customers are more likely to want some allowances, and they will be less willing to pay the regular price or the ticket price. So these are just some examples, but you can think about some other examples on your own, and strategically you have to work toward things like this to be able to increase your net sales so that you will have a positive effects on in maximizing your profit. And of course, to maximize our profit, we also need to work with our cost of goods sold. Okay, cost of goods sold is a negative factor that reduces profit, so we want to decrease cost of goods sold as much as possible so that our profit will be maximized. Then how can we do that? How can we decrease cost of goods sold? One obvious thing is knowing all the elements of cost of goods sold. We can think about negotiating with vendors in terms of those kind of things. So we want to reduce purchases, for example, and that doesn't mean we want to buy less merchandise. We want to buy the same amount of merchandise with less cost. So negotiate with the vendors in terms of the merchandise cost. Also, we can negotiate with the vendor in terms of the returns to vendors so that the vendors will be willing to take the returns in case those items that don't get sold. In terms of the other pricing terms, such as transportation, we would be able to negotiate with vendors so that vendors may be taking care of the transportation instead of the retailer or the buyer has to take care of the transportation cost. Cash discount is another thing another element in the cost of goods sold that we also need to work with. And so we may negotiate with vendors so that we can get more cash discount possibilities and things like that. All of these things are, when you think about cost of goods sold, immediately you think about, okay, let's negotiate with vendors so that we will reduce the cost that we have to pay to the vendors. But another way to reduce our cost of goods sold is this way may not be as intuitive, but if you think about it, the improving merchandise planning accuracy, which we talked about on the previous slide when we talked about increasing their sales, we talked about that. But again, the same thing applies here in reducing cost of goods sold. um, through the ongoing reviews of the merchandise, which is selling well, which is not selling well, so that your next purchases will reflect the target consumers' taste and trends accurately. In that case, you can, as I said in the previous slide, you can reduce your markdowns because you have the right merchandise that the customers will be more willing to buy on the spot instead of waiting for the sales or discounts to be able to buy. So then by reducing markdowns, what happens is that you might have spent the same amount of money to buy this merchandise, so the cost of goods sold dollar may stay as it is. However, cost of goods sold percent is going to reduce. By being able to sell the goods at a higher price, at a regular price, instead of taking a markdown, you are having a bigger gap between the sales and the cost that you paid to purchase this merchandise, which is what we call gross margin, right? So that increases gross margin percent and decreases cost of goods sold percent. And that way, although you may not really do anything about the cost of goods sold dollar, which you already paid to the vendor, but you can decrease cost of goods percent, which will have a positive impact on your profit percent. So finally, what do we do with the operating expenses to maximize profits? Of course, a logical answer would be, let's decrease operating expenses. Then how can we decrease operating expenses? Operating expenses are calculated by adding up all the different categories of expenses. So basically, decreasing every category expenses will lead to a decrease in total operating expenses. We can try to decrease direct expenses, decrease indirect expenses, any different categories of expenses. But one thing that we have to remember is the expenses are there for a reason, right? So while we're trying to decrease our expenses, at the same time we have to consider what impact that decrease in that particular category of expense will actually have on our sales. Like for example, advertisement cost. Advertising cost is a big part of the operating expenses for a lot of companies. Then, so to be able to reduce operating expenses, do we have to stop advertising? Things like that. If we stop advertising, what impact that's going to have on our sales? So, in module number 1, we talked about what impact would this have on profit and things like that, decrease in operating expenses and increase in sales. Usually when you decrease operating expenses, that may lead to a decrease in sales as well. Decrease in operating expenses is a good thing, but an increase in sales, a decrease in sales is not a good thing. So when those things happen at the same time, we have to think about the relative magnitude, right? Whether the decrease in sales is going to be bigger or decrease in advertising is going to be bigger. If we can spend a little bit of money to increase a lot of sales, then we don't want to reduce this money that's spent on advertisement, right? So things like that. So it is all relative. It's not like we're just trying to decrease the absolute amount of operating expenses, but we're trying to be more judicious in selecting the kind of expenses that we will incur so that it would lead to a more positive impact on our sales. That is one thing that we have to think about in terms of what we do to the operating expenses to maximize profit. So we in the last 3 modules we have been talking about the profit and loss statement, what goes into that profit calculation, and what do we do to improve our profits and things like that. Keeping track of profit and loss statements is very important because, as we just discussed, they let us see how we're doing in various categories of our operations. in terms of the sales, in terms of cost of goods sold, in terms of operating expenses, in all aspects of our operation. So it allows us to analyze what we're doing well and what we're not doing well, and that means when we see the areas of operation that are not going well, we can try to take some corrective actions as quickly as possible. It basically allows us to pinpoint the variables or the elements in the profit equation that really need more attention to be able to improve our profit. It's just, keeping track of the P&L statement is just a way for us to be on the right path to improve our profit. This concludes module number 3. I know this module has been a little bit longer than the other modules, and thanks for staying through the long module. The information in this module is extremely important, especially when you work on the second homework assignment. There is going to be a part of the assignment where you have to think about how to maximize profit for a business. And the last few slides that we just talked about in terms of how to maximize profit by utilizing the net sales elements and cost of goods sold elements and operating expenses, and that discussion is going to help you a lot in answering the assignment questions as well. And also, don't forget that you have to work on module problem assignment number 3 as well. All right. Thanks for listening again. Bye-bye.